Most professional money managers can't beat the market. Almost never. And I have the numbers to prove it. A study by S&P Global found that over 15 years, more than 90% of actively managed funds underperform the S&P 500. 90%. Teams of analysts, decades of experience. And they lost to a computer buying 500 companies and just sitting there. Here's why. The market is incredibly efficient. The moment something is undervalued, thousands of algorithms pile in. The moment something is overvalued, smart money gets out. By the time your fund manager spots the opportunity, it's already priced in. The first reason the S&P 500 works: diversification. When you buy an index fund, you're buying a tiny slice of 500 of the largest American companies: Apple, Microsoft, Nvidia, Amazon, JP Morgan. You're not betting on one company. You're betting on the entire American economy. And that bet has never permanently failed, not once. The S&P 500 launched in 1957. Since then, it's weathered the 1970s oil crisis, the dot-com crash, the 2008 financial crisis, the pandemic. And every single time, it recovered. Every single time, it made new all-time highs. That's not luck. That's what happens when you own a piece of the most productive companies in the world's largest economy. Now here's the second reason. Fees. They destroy returns. Not dramatically. Not overnight. Slowly, quietly, and completely. A typical actively managed fund charges around 1% per year. Some charge 1.5%. Some charge 2%. That doesn't sound like much. But over 30 years, a 1% annual fee doesn't just eat 1% of your money. It eats roughly 30% of your total returns. Because fees compound, just like returns do. An S&P 500 index fund from Vanguard or Fidelity costs about 3 to 10 basis points per year. You almost don't notice it. If you're finding this useful, hit subscribe. I put out videos like this every week, and the next point ties everything together. All right, here's the one I've been saving. Warren Buffett, the Oracle of Omaha, the most successful investor of the modern era. In 2007, he made a famous bet. He wagered $1 million that an S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The result? The S&P 500 returned 125%. The hedge fund portfolio, 36%. Buffett won by a landslide. And after it was over, what did he say? When the next generation inherits their wealth, index funds should be the core of their portfolio. That's coming from the man who spent 50 years picking individual stocks and becoming a billionaire. He looked at the evidence. He did the math. And he chose index funds. If the greatest stock picker of our generation says most people should just buy the market, maybe we should listen.